I'm sure you've felt it before. You feel behind financially, but is that really true? In this video, we're going to look at some of the common blind spots that we have as investors and some quick ways to measure them. So as humans, we're pretty awful at getting our head around exponentials, and that's just because we're really bad at thinking in the time dimension. So have you ever wondered why we always overestimate what we can do in a day, but underestimate what we can do in a year? Well, it's things like this equation that answer it, and that's our poor intuition of exponentials playing havoc again. But unfortunately, exponentials are the foundation for investing, especially over long time periods. To illustrate this, consider two people, person A and person B. Both start with £100 at 18 years old and earn 10% return per year, never adding any more to their pot. How much would they have after 50 years? Well, I've given it away a little bit by showing you the graph on the screen straight away, but for every £100, they would finish with £10,671. So they would have multiplied their initial starting money over 100-fold in 50 years. Now, that in itself can be a little bit hard to get your head around because many people immediately jump to the conclusion of 10% a year times 50 years, 10 times 50, 500% or a 5x return. And that would be underestimating your returns by 20-fold, which is a huge mistake to make, even with some back of the napkin maths. But what about if we change it up a little bit? What if in that first year, person A achieved a 50% return and then every year continued along at their 10% per year, matching person B? Well, that 1 year of good returns resulted in changing the 106x their initial money to 145 times their initial starting money, just from one good year out of 50. So at the start of the chart, you can barely see any difference. But over time, the totals start to diverge, and that one good decision gets reinforced on itself, which continues to build on itself. We call that compounding. So the divergence between these two lines will just get even bigger if we extrapolate it out even further into the future. But that's getting into time periods that as humans we don't really need to consider. So why is it important to recognise this blind spot for exponentials, and what can we do about it? Well, firstly, we can't help comparing ourselves to others. Theodore Roosevelt was a US president at the start of the 20th century and is attributed to saying that comparison is the thief of joy. But that doesn't stop us comparing ourselves to others all the time, does it? Whether it be the car someone's driving, how they look, what their salary is, you name it, you can compare yourself to someone else. So what's a simple way to help quantify this exponential that we're struggling with? Well, there's a really good rule known as the rule of 72. Now, we'll just say it only works on fairly small numbers, but it's a good just back of the napkin maths check into what we could be looking at into the future. So if we think back to the example we had at the beginning of the video, we know that the returns were 10% per year. So the rule of 72 says we take 72 and divide it by the return to work out how long it takes to double our money. So in this instance, 72 divided by our 10% return is 7.2. So every 7.2 years, we're looking at doubling our money. So if we looked at that over 50 years, it's roughly 7 doublings. So 100 to 200, 200 to 400, and so on and so forth. And so that'd leave us at £12,800. And you can see I've plotted that on the chart. It might be a little bit difficult to read if you're on a small screen, but you can see that it's not far off where we actually end. So it's a pretty good approximation and certainly much better than our 50 times 10%, so 500% guess. So how can we apply this to our investing career? So if we look at the real long-term global equity growth, so that's growth minus the inflation rate, as taken from the Credit Suisse, which is now UBS Yearbook of Returns, we can see that the long-running average return for a global portfolio is around 5% above inflation. So what does that mean for us? Well, using our rule of 72, we can find that we would expect our money to double roughly every 14 years. So 72 divided by 5 is about 14. So if you're 30 years from retirement and you're saving for it, then every £1 that you invest now will be worth about £4 in retirement. So I've said 2 sets of doubling, 2 times 14, 28 years, close enough to 30 for an approximation. But this also works backwards. So what if we want to get to a £200,000 investment pot by the time we retire? Well, if we're 30 years out from retirement and investing in a global index fund, we can just do that backwards. Instead of doubling twice, we can halve twice. So we can go 200 to 100, 100 to 50. So if we're 30 years out from retirement and want 200k in retirement in today's money, then we need about £50,000. So using just rough guides like the rule of 72, instead of comparing ourselves to others, we can compare ourselves to our future self, which is a much better comparison to make. And it can also be quite hopeful. It can show you what you can achieve in the long run. Now, I would just say, as a word of caution, just remember that the rule of 72 doesn't take into account any future contributions you make. So in that previous example, where we were looking at having 200k in retirement, and that would mean that 30 years out we need 50k, that's if we just stopped contributing now to our portfolio. So really, if you're on track based on that rule of 72, you're actually doing very well and probably well ahead of where you need to be. So why did I make this video? Well, I spoke to someone quite recently about the power of compounding and they just couldn't get their heads around it. So hopefully a few charts and just some quick examples here, if you're struggling with it, has really helped you. If you're interested in more personal finance type content like this and more investing content, please hit the subscribe button down below and I'll see you again in the next video. Thanks very much for watching.